Hello everyone, my name is B. Satyak. I am from CSCD section. My roll number is 20951A054G3. Today my business, economics and financial analysis concept video topic is economics uses and day-to-day life. Economics. What is economics? Economics is the study of how people, firms or institutions choose to allocate resources. Resources are not always rupees or dollars. Time, skill and land are all resources. People making economic decisions with the intention of maximizing their return. For example, a college student might allocate his time and substantial amount of money to earn a degree. In return, that degree will ideally yield him into numerous jobs, opportunities and increased income. Economics in day-to-day life. Economics is useful in life decisions. Some of the most important life decisions are made using economic reasoning. When you choose to have children, whom to marry and where you will live are just few of these. Before deciding on any of these events, a person performs what economists call a cost-benefit analysis. Simply put the pros and weight gained against the cons. If one choice provides more utility or personal satisfaction than another, a decision is made. Household budgeting. Economics permeates into everyone's daily life in the area of purchasing decisions. How much money you have in your bank account dictates what types of purchases you make. Economics groups purchasing choices into three groups: luxury goods, normal goods, and inferior goods. Economics.com defines inferior goods as products less desired where income increases. An example is branded cereal. As you earn more money, you might purchase name branded cereal instead. More normal goods like movie tickets and restaurant outgoings are purchased within rise in income. The purchase of luxury goods like Ferrari or Porsche also rises once a certain income is achieved. Price tags. How much you buy once an item's price tag changes is also an economic issue. The responsiveness to change in price is known as elasticity. If you continue to buy a product in the same quantity regardless of the price change, like gas, then it is an inelastic good. On the other hand, if you cease to buy lattes when the price is raised by 50 rupees, then coffee is elastic. Employment. Georgie Mackey's book Principle of Economics uses a graph to explain how a person allocates her time based on desire for more goods or leisure. In everyday life, this scenario is demonstrated when she turns down a high paying job because of 60-hour work weeks that come with it. Conversely, a person might pick up overtime shift to earn more money at Christmas. Importance of economics in our daily lives. Economics affects our daily lives in both obvious and subtle ways. From an individual perspective, economic frames with choices we have to make about work, leisure, consumption, and how much to save. Our lives are also influenced by macroeconomic trends such as inflation, interest rates, and economic growth. Why is economics important? Importance of economics. How to maximize utility, opportunity cost, how inflation affects us, the effect of externalities should we save, the opportunity cost we face in deciding what to buy, how to use time, how to maximize our economic utility and avoid behavioral bias, how the macroeconomic inflation, economic growth and employment prospects affect our living standards. Individual markets like housing market can influence our standard of living. Understanding issues like externalities we may not like paying petrol tax, but if we see it helps to reduce pollution and congestion and the tax revenue is used to subsidies public transport, it gives different perspective. Applying economics in everyday life. Buying goods which give the highest satisfaction for the price. This is common sense, but in economics we give it term of marginal utility theory. The idea is that rational person will be evaluating how much utility, satisfaction, goods and services give him compared to the price. To maximize your overall welfare, you will consume a quantity of goods where total utility is maximized given your budget. For example, is it worth paying extra charges by airlines such as paying for more legroom or pay to get boarding, priority boarding? Economics suggests we need to evaluate marginal benefit of these services compared to the marginal cost. Sunk cost facility. A sunk cost is an irreversible cost, something we cannot get back. For example, suppose we sign up for a gym membership at 1000 rupees a month. For whole year, we are committed to paying 12,000 whether we go or not. If we are feeling unwell, should we go to the gym to get our money's worth, or should we write off the sunk cost and maximize the marginal utility for the particular day? Opportunity cost. The first lesson of economics is the issue of scarcity and limited resources. If we use our limited budget for buying one type of good, there is an opportunity cost. We cannot spend that money on other goods such as entertainment. Opportunity cost is an intrinsic aspect of most economic choices. We may like the idea of lower income tax, but there will be an opportunity cost in this case. Less government revenue to spend on healthcare and education. Behavioral economics and bias. Traditional economic theory assumes that the man is rational. However, the work of behavioral economics suggests that we can be prone to bias or irrational behavior. For example, we may prone to present bias where we overvalue pleasure in short term and ignore the long term implications. For example, consuming demerit goods like alcohol or not saving sufficiently for the retirement. This insight of present bias suggests we make decisions our future self would not make. If we became aware of this bias and irrational behavior, then we can make better decisions which improve our long-term welfare. Irrational exuberance. Another issue in behavioral economics is that irrational exuberance, or when we get carried away by an asset bubble. Can we be sure we will not get carried away by a boom or bubble? History suggests that many investors are over optimistic about their ability to leave the market at the optimal time and can feel that time is different. On the other hand, in economics, there is always another way of looking at the world. Borrowing is bad, except when it isn't. Nothing in is black and white in economics. It depends. For example, government borrowing to finance pensions for an aging population can lead to unsustainable rise in government debt. However, government borrowing a recession can help economy recover. Diminishing returns. If we like a chocolate cake, why don't we not eat three per day? The reason is diminishing returns. The first cake may give us 10 full satisfaction. The second may give us the lesser satisfaction, whereas the third can make us sick and give a negative utility. People may have different opinions about when in diminishing returns set in. Some students may feel this is after the second point, other students only after considerably more. There are also diminishing returns to money. That is why we don't spend all our time working. Extra money gives increasingly less satisfaction and reduces the leisure time. Diminishing returns to wealth or income. A similar concept is that of diminishing returns to the wealth and income. Does an extra 10,000 give us more utility? Yes, but it depends on our current income. If we have a very low salary, the extra 10,000 will make a big difference. But if we earn 15 lakh per an year, we may not notice that extra 10,000 a year. The importance of this is for choosing the right balance between work and leisure. What is the value in working a long working week? If extra money earned has a limited marginal utility. Externalities. If a firm produces chemicals, it may make a profit, but cause of an at a cause of an external pollution. To ignore this external cost would be to create inefficient outcome. We should make the firm pay the cost of pollution so that it has incentive to minimize or halt external cost. Externalities are everywhere. Public goods not provided by the free market. The free market has many advantages. Private firms tend to be more efficient, innovative, and respond to customer preferences. However, many goods and services would be either be not provided or under provided in a free market. Public goods like street lighting and law and order, also public services like healthcare and education, would be provided in insufficient quantities. Therefore, to optimize social welfare, there is a need for government intervention through taxes and direct public provision. We may dislike taxes, but we would dislike not being able to see a doctor. Macroeconomics affects everyone. Everyone is affected in some or the other way by macroeconomics issues such as inflation and unemployment. Inflation can reduce the value of your savings. If you keep cash under your bed during high inflation, you would be better off trying to buy a gold or some physical assets. Mass unemployment can cause society to fragment. Therefore, there is a need to adopt policies and to try and reduce unemployment. Life cycle hypothesis. The life cycle hypothesis states that maximize lifetime utility. We should try to smooth our consumption patterns over the course of life. It is not good to have substantial income when we are old and unable to move. Spending some more money in our student years will give greater overall utility. This justifies taking out a student loan to pay back when we are working and then saving for a pension in our retirement. So we come to the end of the concept video. This is everything about how economics is useful in our day-to-day life and how economics affects our day-to-day life. Thank you.